Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor. I'm really pleased to have with me once again John Rubino. And before we say hello to John, I want to implore you to go to dollarcollapse.com, dollarcollapse.com. Every day there's a lot of great material there, information on the markets and viewpoints of the markets. I think very worthwhile spending a couple of minutes a day to go there and check out what the content is. And one of my favorite things that John has there his top 10 videos of the week, which he always has some really great ideas, great discussions. These videos are discussions of well-known personalities in the gold and in the investment space in general, but especially focused on gold and silver and the commodities and so forth. John, thank you so much for joining us again.
Thanks for having me on, Jay. Good to talk to you again.
It's always good to have you with us. And what do you make of these gold markets? It's very frustrating to me. I wake up in the morning, I come down here, I see the markets are up in Asia from the close yesterday in New York, usually up through the middle of the day in London. About the time New York comes alive, it just gets whacked more often than not. It gets whacked in just a matter of minutes, and then it crawls its way back up. On the other hand, I guess it was a couple of days ago when it was the opposite happened. Actually, it was pretty low, and then it really took a dramatic rise in New York time as well. So, I mean, it can go both ways, but there was a guy that did a study some time ago, a German guy, and I've forgotten what his name is now, but I know I've looked into it. He said if you invested every day, if you bought gold every day at the close in New York, and then sold it in the early days in New York, you would make a lot of money. And he went through and demonstrated that was the case. So somebody is whacking the market really hard over time. That is to the detriment of investors in the U.S., it seems.
Well, yeah, that does seem to be the pattern, Jay. I know I go to bed a lot of nights thinking, ooh, tomorrow's going to be a great day for the gold mining stocks, because gold is up overseas, and it just has to keep that price until the next day for the miners to go up in response. And then it gets whacked, and you have a way less exciting day than seemed like it was going to be. So, but it shouldn't surprise us that gold is being manipulated, because if it wasn't, it would be the only market that isn't manipulated these days. So as the saying goes, there are no markets anymore. There are only manipulations. So we should be grateful, I think, that gold is still in a bull market. I mean, it's still up dramatically from its low of a few years back, and it's at levels that, first of all, are profitable for people who have been dollar cost averaging. If you've been buying gold all along, you're doing great right now overall. And it's great for the mining companies. If you're a producing gold miner, you probably brought your mine online with the idea of $1,400 or $1,500 gold, maybe less, which means you're generating lots of free cash flow now. You're more profitable than you expected to be. And that's it's a great situation for a company, especially for a big company, because, free cash flow papers over a multitude of sins, and it gives you a lot of opportunities to do good things. And that's the situation that a lot of the big gold miners find themselves in now. They're just raking it in. They're going to report big numbers. And by the way, this is earnings season for the gold miners.
Yes.
So in the next couple of weeks, we're going to see a lot of really impressive numbers out of the majors. And we'll see what that does for their stock prices. It may do nothing, but who knows? Maybe fundamentals actually matter, or will at some point in the future, and this stuff will start to send prices higher.
Yeah, I think they will matter in the future. And it sort of brings me to one of the ideas that Michael Oliver has been expressing over the last number of months or so on this show. He's talking about gold's next major move, or the precious metals' next major move, will come when the equity market finally enters a bear territory, starts to head lower. Now, he doesn't expect a crash. Michael's expecting sort of a layered decline in the equity markets. But on the other hand, if equities go down, I mean, the Fed can hardly allow that to happen, right? Because look at all the pension funds that are in the equity markets now. What's going to happen if the equity markets really start to tank? What's going to happen to our economy? What's going to happen to the pension funds?
Well, when you as a society or as an individual borrow way too much money, you become financially fragile. So you can't handle things that you might ordinarily just kind of shrug off, and in the case of countries and financial markets, one of the things you can no longer handle is an equities bear market. Like if we had a 20% even, let alone a 30 or 40% drop in the value of the average stock in the U.S., we would just spiral out of control because, as you said, so many different entities out there depend on high stock prices for their survival. If you're a pension fund right now and you're only 60% funded, which is almost the majority of public sector pension funds out there, and you've got half your money in equities, that's the half of your money that's actually doing well. Let that drop, and then you're 40% funded, which is basically Armageddon for a pension fund. That's the point at which they throw out their management, bring in new people, and then cut benefits dramatically, yada, yada. It's a catastrophe. And we would see that across the country in all kinds of different entities and everything. Oh, and by the way, an example of how bad things have gotten out there, Jay, is that Larry Fink, who's the CEO of BlackRock, which is the biggest investment company in the world now, is now counseling people to be 100% in equities.
Wow.
Yeah, isn't that amazing? Because it used to be that, you divided up your money between several different asset classes, and then you adjusted the allocation according to your age. But he's saying, no, if you want to retire, you're going to have to work longer, and you're going to have to take more risks, which is, pretty rich coming from a guy who doesn't have to do any of those things. He's lecturing the rest of us on how we're going to have to wait to 75 to retire, and in the meantime, put our money into stuff that could go down by 40%, which would move our retirement date out to 80 or whatever. But that's where we are now as a society. It's getting worse and worse for regular people, while the 1% siphon more and more money from everybody else. So, all the civil unrest that we're seeing out there, a lot of it is, COVID related on the surface, but it's actually people just being really frustrated by the situation that they find themselves in. So any excuse is going to send people into the streets. Look at the videos of what's happening in London right now. It's astounding. And that could spread anywhere, anytime.
Yeah, unfortunately. Well, speaking of the pension funds, I saw a chart just recently that showed over the last couple of quarters or so, especially since COVID started, that almost all of the new money that's being funded for the Treasury, the U.S. Treasury, is being funded by the Fed. The Fed is purchasing the debt and pension funds. Between the pension funds and the Fed, there's almost nobody else that's buying treasuries these days, it seems. So now if this leads me to what I wanted to ask you about, how can we have these spikes up in inflation? CPI, I think the print was 5.2%, the last one, then a PPI was 7.3%. I mean, these are numbers that we haven't seen since the 1970s. And yet interest rates are going down. How do you explain that, number one? And number two, what happens if interest rates start to go up? Those pension funds are not only in equities, they're in bonds and treasuries, and they would start to lose their hides on that as well, right?
This is a really complex financial situation right now because you've got all these cross currents that are mutually contradictory, but they're out there at the same time. You've got this inflation that we've seen. These, by the way, you're right. These are crisis level headline inflation numbers. And don't forget that we don't calculate inflation the way we used to in the 1970s. If we used that same calculation methodology, our inflation rates would be as high as the double-digit rates that we had back then. And 1970s was a decade of massive currency crises, one after another, which culminated in almost 20% interest rates. We had to raise interest rates to 16 or 18%, depending on the maturity and which kind of bond you're talking about, just to stave off a currency collapse. And so remember, we can't do that anymore because interest rates going up like that would just take a blowtorch to most of the leveraged speculating community, which is to say almost everybody these days. So it's really hard to know what to think about 5 or 6% official inflation right now, because you got the base effects from the little mini deflation we had during the pandemic lockdowns, and you've got the global supply chains being all screwed up also by the lockdowns, and then you've got all this money that they created also because of the lockdowns that is just flooding the system and pushing the price of the weirdest things up. Why are cars at record high prices?
Right.
If you're on lockdown, you lost your job or else you're working from home, do you need to go out and buy a new car? That seems like the last thing you would need to go out and buy, and yet everybody's doing it. So I don't have a good explanation for exactly how all this stuff should resolve, because so much of it is, or let's put it another way. Another framework might be necessary to understand this. And Jim Rickards has a good one, I think, when he talks about complex systems, which are something, like the global financial system that requires huge amounts of new money constantly put into it to keep it from spinning out of control. And when it does start to spin out of control, it goes non-linear, which means that yesterday means nothing to what happens today, and today means nothing to what happens tomorrow. So you can't make any predictions based on the immediate past or the long-term past or anything. The system is just bouncing from one thing to another. And that's what this feels like, that house prices should spike during a recession, and that cars are more expensive than they've ever been before, and that stocks are going through the roof despite the fact that interest rates were going way up for a while, and now stocks are still way up even though interest rates are way down. Who knows what any of that means, except that it could be that this complex system, which is the global financial market, is finally starting to melt down. In which case, volatility is the only thing you can talk about with any kind of certainty. Things are going to get crazy out there. But what particular flavor of crazy is very hard to predict.
Mm-hmm. Yeah, it's very hard to predict. You would think, of course, if the Fed allowed interest rates to go where the market would take them, God only knows how high they would be. But they would certainly be a lot higher than they are now, where they're really negative rates in real terms, for sure. And that doesn't bode well, I think, for economic growth. And banks are not making loans now, John. They're flush with cash, but they're not making loans. What do you make of that?
Well, banks don't want to lend at negative rates, right? And who would, really?
Yeah, exactly.
You're getting you're not getting in real terms an actual return. You're actually losing money when inflation adjusting your assets. So banks don't want any part of that, and yet people are still apparently able to borrow a lot of money to do a lot of things out there. So I don't know, Jay. I think that the negative interest rate thing is a very big deal because it historically leads to instability and much higher precious metals prices. That's usually the best environment for gold and silver because it means that something that has a guaranteed long-term zero cash return, like gold or silver. Oh, sorry about the dogs in the background. That will stop in a second, I promise. But that is actually, something with a zero return in the sense that it holds its value. It doesn't go down over long periods of time. Looks great when bonds and cash are losing value at an accelerating rate. So historically, this kind of an environment has been really good for precious metals and by implication the miners. So it's good for us, not good for the world, but it's good for people like you and I who own a lot of these little junior miner stocks. Yeah,
I mean, I think it goes without saying that both of us are not looking to make money and to become wealthy at the expense of other people, but seeing what the Federal Reserve is doing, it is in the process of destroying the dollar, and other central banks are doing the same thing. The Fed has put itself between a rock and a hard place. It can't allow rates to rise, as you just pointed out, or it destroys the equity market. So do you think Finks' idea about owning stocks, he's trusting the Fed will have the equity owners' backs?
That's basically what he's saying, is that the government has decided that it is a public policy objective to have equities and other financial assets go up in value year after year after year because they need that. There's a thing called the income effect, where if your stocks go up you feel smarter and richer, so you go out and spend, and that drives the economy. It makes the economy grow. It's a terrible way to run public policy, but it's the last thing we've got. We have nothing left to keep this thing going except higher equity prices. And so what Larry Fink is saying is, okay, this is just the world that we're in. The government is actively trying to manipulate stocks higher, so you might as well ride along with that. But of course, that only works until it doesn't work anymore. And financial markets cannot be manipulated to infinity, Eventually they blow up on you. And at that point, if you've been following the advice of the don't fight the Fed crowd, you've made lots of money along the way, and then you lose it all in a heartbeat. Yeah. And the way this is set up, that's liable to be just as you're getting ready to retire. Which means you never retire, or just as your family really needs that money for something else and they don't get it. It'll come at a bad time, I guarantee it. So you should not follow that advice.
Just with a couple of minutes left, John, we want to talk a little bit about what Rick Rule was talking about, and that is the mining companies, the big guys, are making a lot of money, but they're running out of ore, which leads us to what I think is the most promising sector anywhere, and that is the exploration sector. You and I have followed some very successful exploration stories, for sure. Several of them are sponsors to this show. What are your thoughts about that? I mean, the big guys are going to have to find the gold. Where they're going to go?
Yeah, I agree with you, Jay. This is the most interesting investment thesis in the world right now. And the basic story is that the big gold miners are not replacing their reserves. So every year they get a little smaller because they dig a certain amount of gold out of the ground, sell it, and they don't replace it. So unless they want to go extinct, they have to find more reserves from somewhere. And the place to find those reserves are the successful exploration companies, those that have found pretty good-sized deposits that are easy to get to and can move the needle for a big miner. And so in a interview Rick Rule just did lately, by the way, he's a star in that field.
Yes, he is.
He's very good at what he does. And he said that the good junior miners, the good exploration companies, will be bought out at eye-popping premiums. That's his term. In the not too distant future, when the kind of a feeding frenzy starts with the majors trying to grab up the relatively small number of really high quality juniors. So those are the things you want to own.
Yeah. Well, a couple of the names that I know that you've been invested in, and I have. Great Bear is one that you like a lot, I think, right? Or you have liked it. My thinking there with Great Bear is that the market hasn't really fully appreciated what they have. But I think once the resources, announced, people can start to understand that. But that would be the kind of thing that the majors are going to want to have: a tier one gold project, high grade, many millions of ounces, that sort of thing.
Yeah, that is a potential tier one asset, which is the biggest, best kind of asset in the gold mining space. And, Great Bear is an interesting story because they basically find gold with every single hole that they drill. Mm-hmm. And the stock went way up. It went from, in the time I've been watching, it went from 39 cents to over $10. Mm-hmm. But now people are bored with great drill results. So they can report spectacular numbers and nobody cares anymore because everybody's waiting for them to publish their resource and then waiting for the bidding wars to start. So this is a pretty low risk time to buy something like Great Bear because they basically have their resource. They've got their property. It's pretty much mapped out. You can tell what it is, but they just haven't put the numbers together and published them yet. So it's fairly low risk. They're not going to turn out to be a fraud or much less good than anybody thought. And they could easily double once the big guys have actual numbers in hand that they can use to put a value on a company like Great Bear.
Yeah, I'm definitely of that camp as well. There's a lot of others that are not as far along. One, of course, is Newfound Gold, which is just astoundingly, it's just crazy, the numbers they're coming up with. And they are still expanding that resource. That one still has some upside. And I'm looking at companies like Novo Resources, frankly, that's starting to produce. Novo is starting, and I think we're going to see, fingers crossed, we'll see a positive third quarter. certainly cash flow positive third quarter, on its way to very significant production. If it can grow itself internally with cash flow, it has a tremendous upside. But there's lots of these things to keep your eyes on, and that's why I would like my listeners to consider subscribing to my letter and keeping up with what John does at his website as well, dollarcollapse.com. Go there every day and just really keep up with what's there. The material there is very valuable. So thank you, John, very much for sharing your time with us again, and we'll look to do it again sometime soon, I hope.
Great. Thanks, Jay.